Over the past several years, small caps haven't just underperformed, they've been overlooked. Capital has concentrated in a handful of mega cap names. Narratives have run hot, and in many parts of the market, price and intrinsic value have meaningfully diverged. But periods like this, where valuation dispersion widens and inefficiencies build, this is where bottom-up investors often find their edge. So today I'm joined by CEO and portfolio manager Dave Barr, and he's here to talk about small caps, AI, and where software opportunity set may actually be improving and not deteriorating.
This podcast is for information purposes only. It should not be viewed as investment advice or as an offer to buy or sell Pender's funds. Our funds are not guaranteed, and any discussion of past performance is not an indicator of future results. Any opinions expressed are as of the date of this podcast and are subject to change. Pender may not necessarily share the opinions of our podcast guests. More important information can be found on our website, penderfund.com/disclaimer.
So welcome, Dave. It's great to have you.
Thanks, Laura. Thanks for having me.
So before we get started into market talk, I wanted to ask a few questions about you. So starting off, how would you describe yourself as an investor today?
How as an investor today? So I think where I've gotten to and where I'm at today is very much focused on finding businesses which I think have really long runways. So big total markets, where we can identify them early in the compounding process before sort of all the financial analysts can figure it out, because the internal economics may not be demonstrated through the income statement, but we can figure it out through our in-depth analysis of the business. So just finding those companies at an early stage, and obviously small cap is probably the best place to be looking for them.
Yeah, definitely. I guess when we looked at Pender's history, you've described yourself as more of a value-oriented investor. Is that still how you describe yourself today?
Well, I choose not to. When people think value, they think of things trading at a percentage of book value, and what Ben Graham wrote about probably 90 years ago. So for me, being a value investor is just make sure you're paying an attractive price for whatever security or company you're buying. So yes, I still consider myself a value investor. I just don't really like using the term, given how people who are not me potentially understand it.
Yeah, because we like to be slightly differentiated thinkers here, and especially given how prominent the term value has become in passive funds, it definitely shows that we're doing things a little bit different here.
Yeah, I can make an argument that a company trading at 15 times earnings is dramatically undervalued, whereas a company trading at 6 times earnings is dramatically overvalued. But one would show up in a value factor model, whereas the other would not.
Looking back more recently, have there been specific cycles or markets that have shaped how you think about risk and opportunities and where we are today?
So what really resonated with me and stress tested me as an investor was getting started in 2000, where right before they rang the bell on the NASDAQ. And at that point in time, it was, we had businesses getting financed at ridiculous valuations, and because they were going to grow forever, that's just not the reality of a lot of businesses. And so, we had big valuations, companies getting financed illogically, and then, when the music stopped, we looked at which companies actually survived, and it was those companies that had real business models, were focused on driving profitability or were already profitable, and were able to grow with the capital they already had on their balance sheet, as opposed to being reliant on the market. So for me, the biggest risk we face is when you're looking at higher growth parts of the market, it's that existential risk of you might run out of money, and you don't want to be reliant on a third party to provide it to you, because when you need it, they are going to take a pound of flesh.
Yeah, that makes sense. So between that time and I guess now, all the lessons you've learned, that sort of guided the framework and how you've built the small cap opportunity strategy?
Yeah, for us, it's always trying to find that mispriced risk and get effectively free options. So if you know a company has like insolvency risk is really low and you can buy it at 50 cents on the dollar today, but you have this wonderful growth option that you're getting for free, you put 10 of those in the portfolio and 2 of them pay off, and it's going to drive great returns. So that's really, if we bat 500 in what we do, we're doing a really good job. The key is, get those 2 outliers on the upside and avoid the two going to zero on the downside. And if you just do those 2 things really well, you're going to do quite well in the fund.
That's the fun part of active management. Just doing slightly better than all your competition. So I guess
it is fun.
I think people that have heard you speak a lot have heard you say the phrase, bringing a private equity approach into public markets. How would you describe that, especially in relation to small caps?
When you in the private equity world, when you buy a company, you can't sell it for several years. So your level of commitment of the investment you're making is way higher. So you just have to get to a way higher level of understanding of the business and have a way higher level of conviction. So for us, what that means in the public markets is taking that whole business approach. So it's, what do we think do we like this business? What business do we want to, what price would we pay? And making sure we, do everything we can to, when we're underwriting that thesis, to make sure we're getting it right. So that means going out and talking to the customers of the company, understanding the competitors, what their strategies are and how it's going to interplay over the next 3 to 5 years. Talking to employees and shareholders and management of the company to figure out if you've got a good team in place to execute on the strategy. So just doing all that deep due diligence as you're developing your investment thesis, to make sure that you're buying companies that you want to own for the long term and that they're priced attractively.
So I guess going hand in hand with that, you're not making a macro call specifically. It's more company driven, how you look at your framework.
I mean, we do follow macro because, when we're looking at businesses we want to own, we're trying to find these businesses that have really long runways. So you're looking for macro tailwinds in specific industries or verticals. But yeah, we're not building a portfolio from the top down. It is very much bottom up because, the bottom up is then you got this great market, but then, is it a good business? Do they have a great product? Do their customers love it? Are they able to actually produce it and manufacture it and sell it at a reasonable gross margin? And can management actually scale up the business over time so that cash flow accrues to shareholders at the end of the day? So there's a bit of macro in there, but this is clearly finding great companies that we think can take advantage of the macro.
Gotcha. So sorry to do this, but I guess staying a bit on the macro side, small caps have definitely trailed large caps for the last decade, I would say. We've seen periods where they've outperformed even just within the last year, last couple months of this year. But how do you look at sort of the structural or cyclical forces behind the underperformance?
We've seen this big move from active management to passive. I think the category we're in as a fund is 10% of the size as it was like 10 years ago. So there's not a lot of price setting going on. And I think what that has driven is a lot of positive feedback loops for indices, which are market cap weighted. So, someone sells their Russell 2000 small cap fund, they buy a S&P 500 index fund, and everybody buys a whole bunch more. Facebook, Microsoft, Apple, all the big names. So it's it becomes a self-fulfilling prophecy where people sell small cap stocks and buy the biggest stocks. The biggest stocks go up, smallest stocks go down, and there's a little secret out there that not many people are aware of, but people chase returns. Yes, it's true. It's true. And so when you've got a certain part of the market that's performing and it performs well on a 3-year rolling, 5-year rolling, it just attracts more and more capital. So the trend just keeps on going. And so we've seen this trend away from small cap. I mean, it's been going on for about 10 years now. We'll probably be a broken clock at some point, and we'll get this right. But it seems pretty overdone when we look at the valuation discrepancies between large cap and small cap today.
Yeah, it's interesting looking at as big movements or big changes over time usually bring big opportunities. So is that how you're looking at it? Are you still excited about the prospect for small cap going forward?
Yeah, I mean, there's still great companies out there, and we have less competition. And like Felix and I always joke about, Warren or Charlie saying, I only want one of two things. It's either no competition or an unfair competitive advantage. So just given the lack of following in the small cap space, because everyone's buying ETFs today, it gives us an advantage as active investors who want to buy a company and hold it for a really long period of time.
Yeah, and that's the alpha generating opportunity, being in that blue ocean, I guess you'd call it.
Well, it was a very red ocean a long time ago, and now it's a blue ocean again. And one day hopefully it's a red ocean because everybody's crowding in looking to achieve the returns we have over the last 5 to 10.
Yeah. So when you see these types of price and fundamentals diverging in such a dramatic way over such a long period of time, what gives you conviction versus thinking it's time to step back?
I mean, what it always boils down to is private market valuation of a company. So if we have a company in our portfolio and we know it's, strategic interest would be wanting to buy it at somewhere $10 to $12. And if that company's trading at $5 a share and we have conviction that somebody wants to buy it at 10, we love holding that company. We may even buy more. So it's really, being able to navigate kind of the volatility and the lack of interest in small cap. It's really for us focusing on private market value. I think the challenge you have in a market where participants are leaving as opposed to coming in is you can't rely on the market to increase your multiple or on your stock. So, for us, one change we've made to the strategy a little bit is we focus more on growth companies as opposed to kind of the classic close the discounts that Ben Graham would have written about in The Intelligent Investor and Security Analysis. Because, to gain investor interest, so it's great if it can be great if somebody comes along and buys the company off you for a 30 to 40% premium. Really what you want to do is you want to let that company grow and compound for a long period of time. But it's even better if the investors start to notice that. As the company increases in market cap and grows, it does naturally get a larger following of active investors who it all of a sudden hits their threshold. But then also if you can actually get into ETF or index inclusion and then start to be included in more passive strategies, you can get your returns that way.
So I guess circling back to the private market valuation, how much of the investment thesis in companies that you're looking at is based on potential takeout? Because it seems like there has been a lot of M&A conversations recently, and we've seen some of the portfolio companies being purchased. So how do you think about that in the current environment, holding an individual name for the long term versus the intention of takeout?
Yeah, so I don't buy a business saying, hey, it's trading at $5 today and it's worth $10, and we want someone to come and buy it. Our perspective is we want to buy that $10 and watch it compound at 15% for the next 5 years. And then our $5 is going to compound at $15, but then it's probably going to re-rate closer to private market value. So you kind of can back yourself into that 20 to 30% IRR on a fully liquid investment. So we I don't go in hoping or looking for a company to be sold. But what it does do is it gives us a conviction to buy and hold it, knowing what the private market value is.
Yeah. And I guess recently there has been a lot of focus on these takeouts with AI becoming so topical and seeing consolidation in the space within technology and software. So I guess how are you looking at AI in general? Are you seeing it as a tailwind, a headwind, and how does it impact the way that you're looking at the portfolio?
I mean, AI is fascinating right now, and there's no shortage of opinions out there. I think there's no, even AI doesn't have a crystal ball view of the future, so we don't actually know how it's going to play out. When we look at other kind of technology dislocations over time, what we do think is this is happening a lot faster than other dislocations. But there's both opportunity and risk associated with a lot of technology companies, but then also companies outside the technology space right now. So for us, it's just trying to figure out what is the immediate risk and what are the immediate opportunities, and then balancing that into how we're analyzing the various scenarios for companies and how things play out over time. But it's there's a lot of unknowns at this point in time.
For example, half of white-collar jobs being non-existent in 5 years.
Yeah, Dario wrote a wonderful piece, and I read that and got incredibly stressed out because 50% of white-collar jobs are gone in 5 years. Is that going to happen? Maybe. I mean, there was a similar kind of concern when the typewriter came out, right? Or when Microsoft Word computers came out and replacing typewriters and how wonderful the word processing software was. So we've seen these types of dislocations before. It's just what's probably a little bit different is the speed of the dislocation, and how different the jobs can potentially change. But again, it's a lot of speculation.
Yeah. So I guess sticking with that, given the fear that's in the industry about AI's potential impact, we're seeing analysts modeling terminal values of 0. We're seeing those passive funds move out of software at a velocity we haven't really become accustomed to over the past few years, where they seem more priced to perfection. How do you look at that dynamic from an opportunity perspective?
Oh, it just goes back to what I was saying right at the beginning, where we are looking for growth options at a really attractive price. And if someone is sitting there saying the terminal value of a software company is 0, well, that's as low as a terminal value can be, pretty much, right? Unless you got debt we hope. Unless you got debt on the balance sheet, things can go sideways. But so, like, if that's where the market's currently pricing, all growth is then now currently for free. So this is recently we've been selling a lot of our non-technology companies and increasing our position in software and technology firms, just given the mispricing opportunity we're currently experiencing.
Yeah, it's exciting when you see that passive movement, and it does seem like for the first time in a little while that active can come in and take advantage, especially if in our opinion, like the business quality hasn't changed, given the emphasis that the team puts on understanding the portfolio companies and what they do and what their advantage is. Do you think that software today remains healthy, or are there going to still be certain names that are potentially terminal value 0?
Oh, there's absolutely terminal value 0 out there, but I think there's a lot of misunderstood software companies as well. Like you look at the software aggregators, Constellations and the spinouts and whatnot, like they've been buying, $5 million revenue software companies for years, right? And if you think, those a $5 million software company has 100 customers, right? What's that? And what's your average revenue per customer? $50,000. Is my math right?
Sounds right.
Yeah. So if you're and they're selling to small to medium businesses. So if you're a 30-person organization with maybe a manager of IT services, and you're spending $50,000 a year on some key part of your workflow, are you going to let that IT services manager, code something that you have no clue what's going on, and then you become totally reliant on this one person to run your business, as opposed to the software that's working just fine? No, you're not. You're just going to keep on using that $50,000 a year software. So that's where particularly in small to medium business, there's other areas where there's regulatory burden and client privacy, where you're not going to, you can't build out all the cybersecurity infrastructure necessary to protect your data. So you're going to be using third parties. There's a lot of areas of the market where, there continues to be moats or barriers to entry for these software businesses. Doesn't mean Claude's not releasing a new LLM or a new model today that's disrupted all of it all of a sudden. But as we stand right now, I think there's some software companies that are in a really great place.
Yeah, there's definitely industries that, using life sciences as an example, if an AI hallucinated, that's a lot bigger of an issue than than you quoted the wrong author in an essay. And there's still parts of what AI can do that it feels like it doesn't fully reflect the critical nature of what these software companies are doing, and they can't be as replaceable as what's being modeled out. So that's been interesting to watch and just see the immediate doom and gloom, almost looking at the Dario perspective of everyone's modeling in a terminal value zero, when there's a lot of things that don't necessarily work that way. Do you think that there's a certain area of the market that the pessimism is most overdone, looking at software, I guess?
Having Constellation Software trading 50% of where it was, when I sit back and reflect on, the beginning, 12, 18 months ago, that wasn't on my bingo card, right? These big, diverse software aggregation platforms, I think, are in a wonderful position right now. And, the positive feedback loop they get is, their potential target, acquisition targets has now dramatically increased. And, just because valuations have come in, but then also from the perspective of, there's probably a lot of people who own a $4 or $5 million revenue software company, and they might be scared of AI, and so they may be a much more willing seller today than they would have been 18 or 24 months ago. So the software aggregators in particular are very well positioned for where we're at today. You mentioned healthcare and regulatory, that as well. I do think it's the deep industry expertise. So I think the deeply embedded vertical workflow companies are probably better positioned than a big horizontal company. It's kind of a period of time where it used to be, you wanted this infinitely scalable software with a huge market, and those were the companies that were gonna you really wanted to own. And now those are probably the ones most at risk. So just going into the more boring part of the software world, the vertical players and kind of the people who are deeply integrated in workflows.
Yeah. I know a company like Salesforce has come up a lot as being a real impact to the negative, and just wondering how something that was so integrated and had a lot of growth at this point looks very different. Similarly, Microsoft, even though it has exposure to AI, obviously, is down pretty substantially, even just on the year. So we're seeing pretty big movements, like not unlike Constellation, but it looks a lot different than it was 6 months ago.
Yeah, well, their CapEx spend looks a lot different than it does 6 months ago as well.
Yeah, that's yeah.
So
It's
I mean, the infotech software universe has done so well, and all the compound bros get all excited because the return on invested capital is so high, right? And all of a sudden the equation's now changed. Like, those businesses didn't invest any in CapEx forever. I mean, any's a bit of an overstatement, but like, CapEx was very low in those businesses, and now it's just like it's skyrocketing. And so how does that change how people view those businesses? Might be time for a multiple re-rate.
Yeah. No, it is pretty astounding seeing just the amount of capital that's going into the transition for something that used to be so capital light. When you're looking at, I guess, on the other side of the spectrum rather than the negative for AI beneficiaries, how do you determine what would be durable value creation rather than just the hype that we're seeing in the market right now?
It's a difficult question to answer because we haven't seen a lot of successful monetization of AI so far.
Yeah.
Like a lot of what we're seeing is, chip manufacturing, data center build out, and like those business cases are not proven out yet. We're still like really early in this AI revolution that's happening. So I think it's a difficult question to answer because I think that the monetization is going to be happening at the agentic level, not necessarily on the infrastructure level. So
yeah,
TBD.
So ultimately, trying to figure out the numbers over the consistent narrative that's out there.
Yeah. So I think one thing that worked really well coming out of 2000, .com boom, was like looking at the businesses that actually had real revenue, not circular financing agreements, but like real revenue and real business models. And so where you could go talk to the customers who loved what was going on. And, I think we're still in the process of, let's lay optic fiber underneath the ocean. Let's put .com on a name and the stock's going to go up. Like there's just, we're very early in what's going on, and, trying to figure out what the successful business models are. It's probably a little early in the game. It's more 1999, 2000 than it is 2002, 2003 when, people thought pets.com was a great idea in 1999. Not so much in 2003.
Yeah, as there seems to be a lot of pets.com out there currently. So I guess figuring out what actually is going to make sense is the real struggle or challenge.
Yeah. And there will be a point in time where we're starting to see like these companies hit revenues on, however they're trying to monetize AI or applied AI technologies. And when we start to get more depth on that and understand those business models, that's when, competition is going to come in, people are going to lean in, and it's going to be a really exciting time to be investing again.
Yeah. It's getting exciting now.
There's always something to do.
There's lots of change. Every day you get to show up and like, oh, what new models here now? What tweet is out there?
What industry is going down 20% today?
Yeah, trucking. That's the logical problem with AI is to see a massive trucking sell-off.
Yeah. So anyways, we'll just continue to take advantage of these short-term opportunities right now to get the positions on businesses we really like. And continue to assess the framework.
Yeah. Is there an example, maybe it doesn't necessarily have to be a current holding, but that represents sort of your style and process, maybe when you're facing this type of volatility, not even specific to AI, but a time in the past where you've seen a lot of change and how you took advantage of it?
Yeah, I mean, when we talk about, the world's always changing, and financial markets just can act pretty irrationally around these changes. And I like the freshest in our memory is 2020, and then we had a big tech IPO boom in starting in late 2020 and going into 2021, where people thought there was this massive shift to people moving more and more online. And so a lot of these tech companies had, big valuations because all of a sudden their TAMs increased dramatically. And then, about 8 months later, 12 months later, IPOs at $12 are trading at $4. And I'm speaking specifically about a Copperleaf, where it's okay, well, it IPO'd at 11 or 12 and it ran up to 24. Well, it wasn't worth 24. And then when it came back to 4, it's well, it's sure not worth 4. It's probably worth 10 or more. So that was a great opportunity for us to, leverage our knowledge of that business, our understanding of what we thought private market value was, and just take advantage of the market mispricing on irrationality on both ways, and made it a big position below $5-6. And unfortunately, it was sold way too early.
I guess when we're looking at the market right now, do you think that there'll be more opportunities like that with what was the 2021 IPO class was really our last influx of new inventory of new companies going public, especially in Canada? Do you think that the tide is turning in that way as well?
I don't see a bunch of companies coming public in this market. People take companies public because they think they can make more money. So they tend to do it when valuations are really high, not when valuations are really low. And this is a low valuation technology market. So I don't expect to see much activity. For us on the opportunity set side, what we see as really fascinating right now is, the software businesses that, these higher growth businesses, particularly ones that have historically, been losing money. Those are getting hit really hard right now. Some of these are trading, some of these stock, there's one company I'm thinking of in particular, it hit $70 a little while ago, a few years ago, and it's trading under $20 today. Even though it's a way better business today. So where we look, where I think the best opportunity is right now is those types of software businesses that have historically lost money that we think are going to start making money, be cash flow positive, and their incremental free cash flow is going to continue to increase over the next 3 to 5 years. So you can hit that inflection point of losing money to making money. You're going to get a multiple re-rate right away, and then you can own a business growing at 30% at a great price and continue to ride it all the way for a long time. It's a nice wave if you can catch it.
Yeah. But I guess on the other hand, when you see companies going that trajectory of market maybe missing something that you feel like is unwarranted, what is the point that would make your thesis break and that you would actually change your mind on a company and realize that this may not necessarily be an inflection point, but a midway down?
Yeah, it comes back to understanding your thesis in the first place. So, if you're saying, okay, this company is going to go from, negative 2% EBITDA margins to positive 2% EBITDA margins in 24 months, if they're still at negative 2% EBITDA margins, clearly they're not scaling up like they need to. And so it's understanding the why. Sometimes there's good reasons. A lot of times, it's just the business. So it's understanding that, but it's really going back to, when you buy it, understand where you're at, where you think it's going, and then holding yourself accountable to measuring it against those benchmarks.
Yeah. And I guess running a fairly concentrated portfolio, you keep a pretty small number of names, especially in small cap opportunities. It gives you the capacity to monitor these types of things on a fairly frequent basis.
Yeah, because we have not every name in the small cap portfolio is, of that nature. So we've got things that are much more predictable and, we're not looking for that massive home run on it. So doesn't require as much attention, but the ones where where there is probably a bit more risk because they're currently losing money, we have to be very tuned into.
Okay. We have a couple of fun questions for you, maybe.
Oh, is this like bonus homework?
Yeah, it's bonus round.
All right.
Let's say you fast forward 5 years from now. What do you think investors may have misunderstood about the current environment?
I think a lot of people are going to underestimate the impact AI has.
Under?
Yes.
From the Dario perspective, or how would
well, I don't know what the answer is, but I'm pretty sure in 5 years, everyone's going to be, oh, wow, that was way more impactful than I thought. Kind of like when you go to, like, if say we are in 2002 right now and you go to 2007, and how well Amazon and like a bunch of these companies had Salesforce and all these SaaS companies had done coming out of the .com boom and bust. I think we'll probably see something similar, where it's like, and then it's going to be perfectly obvious to everybody in hindsight, because the greatest investor of all time is hindsight capital.
Yeah. I think it's interesting when we're in these types of rooms constantly and we're kind of reading the same media, a lot of us, and being around the same people. And we are thinking about how AI is changing things so frequently and how it'll impact companies. But then you go out on the street and ask someone, have you used Claude? And that's just a very strange question. One of my favorite things I saw recently is on the Super Bowl ad, Anthropic they ran one for Claude, basically saying that ChatGPT has ads and they don't, and this is why we're beneficial. And that was one of the lowest ever consumer reacted ads the Super Bowl's ever run, because people didn't understand. They didn't understand why that was relevant and what Anthropic was. So when we're in these types of rooms where we're constantly talking about, constantly thinking about it, it's pretty easy to not understand that that's not necessarily the norm, and that just because it's everything we think about on a daily basis, that's not what everyone else is doing.
I don't think you're going to be cool at a cocktail party asking people what they're doing with Claude, Laura.
What? It's like, who's your best friend, Claude or Gronk? Yeah. Okay.
However,
so
the Instacart Super Bowl commercial was fantastic.
Oh, I didn't know I needed to see Ben Stiller flip off of a stage until I saw it happen in real time. And I realized that's what I'd been missing.
It's completed a lot of people.
All right. We have your two final fun questions. First one, why do you think the current market might be a better entry point than it feels?
Because it doesn't feel like a very good entry point.
Perfect.
I bet you're expecting an answer just that, like, snippy, hey?
No, that's what I wanted.
No, it's the best entry points are always when there's a lot of uncertainty. As soon as you pay a very expensive price for certainty in the market, and right now there's a lot of uncertainty, which will create some volatility. It will create some losers, but it will create some wonderful winners emerging out of this.
Yeah, I think so too. It's exciting. It's fun to look at things rather than just have everything pass you by from at least especially from a valuation perspective. There was, for a while there, it just seemed like, I don't know, everyone only wanted to look at the same few things. Now at least the market has broadened and people are more interested in learning about small companies, medium companies, not the Magnificent Seven, basically.
Oh, the time may have finally come.
It's here.
It's here. Active management will rise from the ashes.
Yes. We're like a phoenix. Okay, last question. What is a book or podcast that has influenced how you think that you would like to recommend to our audience?
I think Chip Wars is very relevant, given the analogies between kind of the GPU battle we're seeing today and the historical chip battle that basically found in Silicon Valley. So I think that book is incredibly fascinating. My hot off the presses favorite podcast I listen to, and not just because they clinked glasses, but Cheeky Pints, where John Collison interviewed Ben Thompson from Stratechery, which I've been a long-term subscriber to. So just a lot of great conversations around AI in that podcast.
All right. Well, that is the end of our show today, Dave. Thank you so much for your time. This has been a really interesting conversation, and look forward to seeing what happens with the fund the rest of this year. Okay.
Well, thank you, Laura.
Great.
Pender is an independent, employee-owned investment firm located in Vancouver, British Columbia. Our goal is to protect and grow wealth for our investors over time. To achieve this, we seek to understand the quality of a business or security, obtain more value than we are paying for, deploy capital in flexible mandates, and mitigate downside risk. We have a talented investment team of expert analysts, security selectors, and independent thinkers. They manage a suite of niche investment funds with active, concentrated portfolios of value-based, occasionally contrarian investments. We invest in our funds too. You can learn more at penderfund.com.